Previously on You, Me, and Wall Street.
And every time we hear a report on what the market did, we hear what the Dow did. And it has 30 stocks. Let me give you what I promised you earlier in the show, and that is a more sophisticated way to gauge what the market is doing. Now folks, what I want to share with you is what the S&P 500 is. Of course, the 500 stands for 500 companies. And folks, I'm telling you, this is so important. To make money in the market, you've got to take advantage of every opportunity. Now let me ask you, which do you think would give a more accurate reading? 30 companies or 500 companies?
Unlock the mystery of investing and gain the knowledge you need to improve your investment decisions. It's time for You, Me, and Wall Street. Now, here's your host, Steve Kiefer.
Hello, smart investors, and welcome to You, Me, and Wall Street. Tonight, we're going to answer two questions. The first question is, how much money does it take to make money? How much money does it cost you to make money in the market? We're going to answer that question. Second question is, have we moved into a new paradigm of investing? Many experts are saying that the old ways of investing are now obsolete. Is that true? We'll find out tonight. Let's go to work. All right, so we all know the adage, it takes money to make money. But here's what I want to do tonight. And I'm going to give you several constants, which means we can compare the different investment vehicles to the same numbers. The first constant is 3% inflation. For all of the equations we're going to do, inflation will always be 3%. The second constant is taxes are going to cost us 1/2%. So every time we get a profit or we make money, we'll take 1/2% away for taxes. And the third constant, and the most important one, is how much money does it take to make $1? That's what we're going to do. We're going to look and see what amount of money does it take in what type of investment to make $1 after inflation and taxes have been taken out. So if you're with me on this, let's jump in. You're going to find this very interesting. Let's start with CDs. CDs are something everybody knows, and many people believe in them as investment vehicles. I prefer to look at them as cash equivalents. But let's talk about a CD. Let's say we bought one that pays 4%. So we bought a 4% CD. Now, we got to subtract inflation, 3%, which means we have 1% left, and then we take away half of it for taxes. So a 4% CD is now paying us 1/2 of 1%. So how much money does it take in those CDs to make $1? Well, if we invested $100 in a CD and we got 1/2%, that's 50 cents. So our conclusion is, folks, it takes $200 of a CD paying 4% to make $1. That's our first equation. $200 of a CD paying 4% to make $1. Now let's go to the next logical progression, which would be bonds. Let's say we buy a corporate bond that's paying 6%. And let's go through our same rules. 3% taken out for inflation. That means that bond is now paying 3%. We take 1/2% away for taxes, so the bond is paying 2.5%. Now, how much does it take for that bond to make $1? How much money do you have to put in? And the answer is $40. So you have to put $40 into a bond paying 6% to make $1. CDs, remember, it took $200 to make $1. Let's go to the third, mutual funds. Now there's something very important here I want you to understand. We've just gone from ordinary income, which means you're paying ordinary income tax, into a realm where you're paying capital gains tax. So your tax bill on these next two will be lower. but I'm going to keep everything constant. So we're still subtracting only 0.5% for taxes and 3% for inflation. Mutual funds. Let's say we're in a mutual fund that is averaging 10% return per year. We take out our 3% inflation, that's 7%. We take out our taxes, that's 0.5%. So now we're stuck with 6.5%. It takes, are you ready for this, folks? $15.38 of a mutual fund paying 10% to make $1. Now let's recap and go back to where we started and get up to this point again. $200 of CD money paying 4% to make $1. $40 of a bond to make $1. $15.38 of a mutual fund paying 10% to make $1. Now we're going to go to the fourth and final investment, and it's getting a little bit high, but folks, although this is a hypothetical example, these numbers could be real. If you buy an investment that pays this type of interest and the other numbers are true, then we're very accurate. So let's see if this is true on this fourth one. Stocks. And this stock, let's say it has a 15% growth per year. It's a growth stock, it's doing great, and it's paying 15% a year. We take away our inflation and our taxes like we did before. That leaves us a return of 11.5%. Folks, it would take $8.70 in this stock to make $1. Now let's go back and review. $200 in a 4% CD to make $1. $40 in a 6% bond to make $1. $15.38 in a mutual fund to make $1. And $8.70 in a stock to make $1. Now, let me put this another way. Let's say we put $1 million in. The CD, after we take everything out, is going to give us $10,000 of spending money per year. If you put that same million into bonds, your income would go from $10,000 to $25,000. If you put that same money in the mutual fund that's paying 10%, your income would go from $25,000 to $65,000 per year. And if you put it into stocks, your income would go to $87,000 based on our, again, hypothetical situation. So as you can see, risk takes on many faces. And in this scenario, the risk is tying up too much capital for too little return. So the question here is twofold. Number one, how much money does it take to make $1 in return after taxes and inflation? We answered that. The more important question is, how would you like to raise your income by 150% by going from a CD at 4% to a bond at 6%? Or how would you like to raise your income 550% by going from a bond into a mutual fund paying 10%? Folks, it takes money to make money, but you have a limited amount of money to invest. And the less you have, the harder it has to work. Now, I'm not advocating you go out and buy a bunch of mutual funds and expect these kind of returns, because it's much more detailed in the investment strategy than that. But I am telling you that CDs, although they seem safe, and they do have some safety features, can actually hurt you in the long term. And on this show, and in our company, and in our philosophy and our strategy, it's all long term. We don't think in terms of a year or two or 5. We think in terms of 15 years, 20 years, 30 years, more. That's how we focus, and that's how you need to focus to be a good, smart, intelligent investor. All right, folks, if you'd like more information on what we just talked about, how to make money and how much money it's going to take to make that money, go to our website, youmeandwallstreet.com, and you'll find good information there. Now it's time for Rapid Fire. Put your seatbelts on. We got a great one for you today.